Thanks for joining us today on The Close. Markets close in a half hour's time, and it looks like the TSX will hold another record. 30,057 is where we are right now. We were just above 30,000 yesterday. So once again, the TSX looks like it'll have a record close. Let's get to the stories we are following in the BNN Bloomberg newsroom. Canada's monthly GDP fell 0.3% in October. Statistics Canada says the manufacturing sector fell 1.5%, mostly because of a drop in machinery production. Wood product manufacturing reported its largest decline since April 2020, reflecting the impact of U.S. tariffs on Canadian lumber, service disruption due to strikes, reduced public sector activity, alcohol retailers, and transportation and warehousing. Canada recorded a budget deficit of more than $18 billion between April and October 2025. It's a 26.6% increase from the same period last year. Program expenses rose with a major increase in transfers. Revenue also increased with import duties that countered American tariffs. And the Canadian Pension Plan Investment Board and Goodman Group have agreed to set up a multi-billion-dollar European data center business. The Australian Industrial Property Investment Manager and the Canadian Pension Fund Manager will initially invest close to $4 billion Australian dollars to develop data center projects in Frankfurt, Amsterdam, and Paris. Construction due to start by the end of June of next year. Holiday retail spending in Canada up 4.4% annually. That's coming from Visa's Retail Spend Monitor. In-store shopping dominated with 88% of total sales so far, and online sales rose to 12%. Clothing and accessory sales grew 10%, leading all retail segments. Visa says AI is beginning to shape how consumers discover products and compare prices. The monitor analyzed retail sales activity between November 1st and December 21st. And once again, another record close is what it looks like for the TSX. We're still a half an hour out. It's at 32,053 right now, up 30% on the year. Moving south of the border, the S&P 500 has a 28-point gain today, 0.4 of 1%. The Dow Jones moving up 80 points, 0.2 roughly of a percent, and the Nasdaq gaining 123 points on the day, about 0.5% move up. Stocks rose for a fourth consecutive day as artificial intelligence names continue to outperform during a holiday-shortened week. But my next guest says the market's narrow leadership provides opportunities in high-quality companies that have lagged so far. Let's go to Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Thanks for joining us today.
Thanks for having me.
Where are you seeing the opportunities at this point?
So it's been really a risk-on trade for the last 18 months with more high beta, high volatility stocks in the leadership. Much of that is in lower quality, unprofitable names. Yes, you have a select group of companies like the Mag 7 that have done pretty well, but overall the broader averages have outperformed because of those more volatile names. So we are inclined to go into and to advise investors to go into more high quality, lower volatility names in order to perhaps get a fair or really robust return in 2026.
Okay, so the companies you're looking at, the stocks you're looking at, are they sector specific or are they sort of wider across the board?
Yeah, they're more factor driven. We're looking for companies that have durable earnings growth, that have a higher return on invested capital and have very little debt. Those companies also, many of them, have a rising dividend overlay on them. And when you put that all together, you really get a lower beta portfolio that is much more consistent in their returns over several market cycles.
Okay. So are you suggesting investors pull some money off the table for tech to put into other sectors, or really just take money that might have sitting to diversify?
Yeah, I mean, think of it this way: if you're investing in perhaps a quantum computer company that has no profits and is trading based off of just a story and excitement, you may want to consider buying a company like IBM, which overall has a robust line of software, which is about 45% of their revenues. And as well, they have mainframes that are growing in a top line growth of 4 to 5% or 6%, and dividend growth that's going to be quite robust over the course of the next 12 months, but also perhaps over the next 3 to 4 years. So what I'm suggesting is you ratchet down the risk in these high momentum names that really don't have earnings to them, and you go into maybe more of the steady Eddie names, and you could do that even in technology.
Okay, so you mentioned IBM as one. What do you like a little bit more, if you can expand, about IBM?
Okay, so they have a consulting division that has been really growing at maybe 1 to 2%. We could see that consulting side start to ramp up as companies become more out to invest in the solution of artificial intelligence. This rollout's going to be very slow. The market's anticipating, though, that it's going to be, overnight. We're anticipating that you'll start to see momentum build in that, and that will benefit their consulting division. Their mainframe division, that may be a cheaper alternative to moving for corporations to moving all of their data off campus, and as well, they can ingrain into their mainframe smaller, lighter artificial intelligence models that will be a solution that can be much cheaper alternative to the alternatives that many of these hyperscalers are using or utilize or selling. And then they have that software division that I mentioned that's going to become a much larger piece of the pie. We're anticipating that division to perhaps grow at perhaps between 10 and 12%. So overall, you can get a valuation you can buy a company that has a reasonable valuation, rising dividend, and a sturdy balance sheet. And you can also participate in this megatrend.
Okay, Cisco is another name you like. What do you like about Cisco?
Wow, Cisco was a darling during the dot-com era. This company now is trading roughly about 15 times EV to EBIT. Its growth rate is anticipated to be around 6%. Anything north of 7 or 8% in a consistent manner, you can see the stock price go higher as well as multiples expand. A couple of reasons for that. One, just their very basic switch router business, campus. There's going to be a campus refresh. Basically, companies are going to have to refresh their backbone in order to be able to handle all the data that's coming from this next generation solution with artificial intelligence. As well, when it comes to the data center build out, they also will benefit from that mega trend overall, in particular overseas in the sovereign data centers. So we see that their wind is at their back now, that their cyclicality within their main business is behind them, and now you're going to start to see more steady revenue growth. Again, a company that's growing on the top line, margins are going to be expanding, and you're going to have a rising dividend with very little debt. The valuation is also, not at, levels that are unreasonable. This is, more of a value play in the tech world.
Chad, I got to leave it there, sir, but thank you very much for spending some time with us. Have a good holiday.
You as well. Take care.
Coming up next, the economy contracted by 0.3% in Canada. That was for October, representing the biggest decline in about 3 years and raising concerns about ongoing trade uncertainties that could continue for next year. We're back in a moment. Canada's GDP fell 0.3% in October, which more than offset September's gain of 0.2%. My next guest says despite likely dodging a recession, the Canadian economy still does face some headwinds. Let's go to LJ Valencia, economist at Desjardins. Thanks for joining us today.
Hi, thank you for having me.
So manufacturing was up in September, but down in October. Any obvious reason for the month-to-month change?
Well, one thing that stands out with today's numbers is that machinery manufacturing has gone down quite significantly after helping contribute to the manufacturing strength in September. But another sort of interesting tidbit of information we can glean with today's data is that wood manufacturing fell, likely due to the tariffs that were introduced on wood products during the month. So those are really two interesting informations that we can glean from on the manufacturing side especially.
Okay, so the tariffs for cabinetry and furniture, those are the kind of things that were hit and that showed up in the October data.
Absolutely.
Okay.
That's really a defining factor that's caused some of the weakness that we've seen in the wood manufacturing subsector.
Is there anything more that we've seen in the numbers that are directly affected by tariffs for the month of October?
Well, I suppose there's a lot of sort of one-off things that we've seen in today's monthly GDP data that kind of makes it difficult to say whether or not, there's a lot of trade impacts the trade war is sort of influencing some of these sub-industries. Say, for example, if you look at transportation warehousing, there was a lot of weakness there because of the recent postal worker strike. And if you look at, say, for example, on the public sector for services, the Alberta teacher strike had an impact on the numbers there. But if you do look, say, for example, in retail trade, it has fallen for the second consecutive month. And also wholesale trade, which has fallen for the second time in 3 months.
Okay, so retail, sorry to interrupt you, retail trade, I guess, would be one affected by tariffs. Then that would explain why the numbers are down?
I suppose, but one thing to keep in mind is that one data point isn't necessarily a signal, a start of a new trend. Obviously, we'd have to wait for more data to see if this weakness persists in the coming months. But at the moment, at least what we can see so far is there is some weakness in a lot of subsectors that as we've seen in today's monthly GDP data.
Okay, what is your take on construction activity declining?
Yeah, so it's quite unusual to see the construction sector decline for the first time in 6 months. Now, again, as I've mentioned before, one data doesn't necessarily imply that this is something that we may see moving forward, but there's other factors as well that could influence the trajectory of the construction sector moving forward. Say, for example, housing sector activity, the sort of the state of housing starts as is. These factors can definitely change, for example, the trajectory of the construction sector moving forward.
Okay, so because we've seen some weaker GDP numbers for October, I know the November outlook so far looks a little bit different, a bit of an upturn there. Do you think we've seen enough information here that could cause the Bank of Canada to change course?
At the moment, there's some of the recent data doesn't really, our view is that the recent data doesn't really move the monetary policy needle much for the Bank of Canada. If we refer back to the latest interest rate announcement, the Bank of Canada and the Governing Council has reiterated that the interest rate is appropriate enough as it is to keep inflation close to 2% target and also to guide the economy as it undergoes through this period of trade-driven structural adjustment. So again, in our view, the latest monthly GDP data for October doesn't really move the monetary policy needle much.
Okay. We also, again, as I mentioned, have a quick look at the November information to date. It does show a small turnaround. I'm wondering why or how you attribute that turnaround that Statistics Canada puts out for November.
So, yeah, I mean, with the limited information that we can glean from Statistics Canada's current flash estimate, they seem to suggest that there will be some gains in sectors such as educational services, construction, and some rebound in transportation and warehousing, likely as we've seen a recovery following the end of some of these postal worker strikes. But there seems to be persistent weakness as well in resource extraction and manufacturing. And so overall, I think that's the information that we can glean right now with StatCan's flash estimates.
Okay. LJ Valencia, economist at Desjardins, thanks for your time. Coming up next, the U.S. economy grew at a much greater than expected pace for its third quarter. We'll talk about that when we come back. The U.S. economy grew in the third quarter at its fastest rate in 2 years, driven by strong consumer and business spending. My next guest says growth benefited from the AI CapEx cycle, though the primary factor was the resilient U.S. consumer. Let's go to Oscar Munoz. He is Chief U.S. Macro Strategist, TD Securities. Thanks for joining us today.
Thank you for the invitation.
So a weak consumer sentiment, we know that. Even today's numbers show that, but softer labor market as well. What's driving the growth?
Yeah, that's the million-dollar question for economies here. But you go back to the GDP print for Q3 at 4.3% quarter on quarter from July to September. That's the same period where we saw job gains really markedly slow down. That tells you a little bit about productivity growth. We're tracking 5% productivity growth for Q3. It was already very strong in Q2 as well, where the economy also expanded at a very solid pace. So I guess you have to buy the story that productivity is here to stay. And it's actually probably something that the Fed is already assuming in their projections for 2026.
Okay, so how much, what does that indicate? How much of it is or could be AI capital expenditure?
Look, I think if you look at just the investment side of the report, AI continued to contribute a good chunk of it. If you read it from that perspective, 0.5 percentage points of growth that we saw today for Q3 was from AI investment. But if you actually do the math, most of that is imported. So the real impact on GDP growth is not as large. But again, it is a big driver of investment. It will probably continue to be a key story for growth in 2026, but we don't think it's going to be as strong as it was in 2025.
The suggestion is that things will slow down in the fourth quarter for the U.S. How much of that will be because of the government shutdown?
Look, a good chunk of it, we're assuming 0.7 percentage points is from the shutdown. That will come back in Q1. So you're going to see the shock in Q4, but you're going to see the payback in Q1. Actually, as you mentioned before, the main story for that upside surprise in economic activity for Q3 was the consumer, particularly the spending on services. We know now in Q4, given the data that we track, high-frequency credit card data, we know that the consumer is stepping back in terms of spending. So I think it's going to be a two shock to the economy in Q4, government shutdown, and consumers actually slowing down their pace of spending in Q4.
Okay, so consumer spending has been still strong, as you were talking about what could be to come for the end of the year. But consumer spending has been pretty strong so far. And I'm wondering whether or not tariffs have worked through the way you thought they would, or perhaps they're being absorbed by retailers. And that's why we're seeing, at least until now, consumers still spending.
Yeah, I think it's a little bit of both. I think so far, retailers, U.S. companies have been absorbing the shock. Some of that has been passed on to the consumer. We see it in goods inflation, right? You see some of the items that are highly exposed to trade with China, for instance, toys. You've seen the price increases there. So on the good side, you've seen pass-through. Certainly not as strong as most of us expected earlier in the year. But, to go back to the consumer is not an aggregate consumer story. I think it's very bifurcated. I think you've probably heard about the K-shaped economy. Most of the spending is being done by the upper income consumers. They continue to spend out, particularly on services. And if they continue to do so, the consumer is going to look good in the aggregate. So I think that's what we're seeing at the moment.
Okay, so we talked about the fact that the last quarter of the year could be a little bit weaker. It could be weaker for the consumer as well. But next year, we have to factor in, of course, tax refunds, the one big beautiful bill working its way through. How do you offset them?
Yeah, look, I think we're very positive on economic activity for 2026. I think Q1 could be a very strong quarter as well after slowing down, which is what we assume in Q4. You're going to see the tax refunds, as you mentioned, that should lift or maintain consumers spending strong. You're going to see the payback from the shutdown. And to be honest, Q1 data tends to be strong. January, February data is usually firm. It tends to surprise to the upside. There is some seasonality there, but you go back to prior years, January, February inflation, payrolls, they tend to beat expectations. So I think Q1 right now is set up to be a very strong quarter, and then the rest of the year, we're looking for the economy to expand close to its potential, around 2% growth. So I think the economy will just do fine. The main question remains the labor market. The labor market continues to lose momentum. You've seen the unemployment rate continuing to move higher. So the big question mark for the U.S. economy is what happens to labor market conditions at the start of the year, whether the unemployment rate stabilizes at the current levels at 4.6%, but if that continues to move higher, I think that will really have an impact on what happens with the U.S. economy in 2026.
Can you give me your outlook for inflation for 2026?
Definitely. So we do expect pass-through to remain part of the story in Q4 and in Q1 as well. We're seeing inflation probably rising to 3 or 3.1% between now and the first half of next year. But after that, I think the tariff story goes away. It phases out. And we think that services disinflation is what's going to be the main driver of the story in the second half of the year, particularly explained by disinflation in the housing segment. OER rents, we expect that to continue losing momentum and dragging down overall inflation toward 2.5% by the end of 2026.
Okay. And then where do you expect the Fed Reserve to land? You mentioned job losses and that weakness continuing. What do you expect for cuts next year?
So we do have additional 3 cuts from the Fed pencil in, now more gradual than what we saw since September this year, 1 per quarter, 1 in March, 1 in June, 1 in September, 25 basis points each. Now, there is a big question mark about what happens in March. We think January is a done deal. I think the Fed is going to pause. March is a big question mark because of what I just mentioned. I think that the economy will probably show resiliency. It'll probably the activity will remain strong. So it'll go back to the labor market, as I was mentioning. And if the labor market continues to stabilize at 4.5%, 4.6% in terms of the unemployment rate, I think the Fed can stay on hold for a little longer here.
Got it. Oscar Munoz, thanks for that. The closing numbers are coming up. Stay tuned for that. Here are the closing bells for the end of the trading day. At the Nasdaq, Granite shares ringing the bell. And in New York, Little St. Nick Foundation ringing the bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX Composite has another record close today. It's at 32,058. It closed above 32,000 yesterday for the first time. A 58-point move up today. That's about 0.2%. The S&P 500, a 31-point gain today, almost 0.5%, taking it to 6,909. And then the Nasdaq, 133-point move up. That's 0.6% to 23,561. Let's get to the movers in Toronto. Strathcona Resources dropping today almost 26%, so $10.16 down per share, evening out at $29. It's up now just about 5% on the year, but Strathcona losing almost 26% just today. Lithium Americas is the next stock we are looking at. It's down more than 3% today, a loss of 21 cents a share to $6.53, but it is up almost 53% on the year. Let's go to the other side in the green. Bausch Health gaining today 4.5% or 44 cents, taking shares to $10.04. NFI Group also a gainer today. It moved up 4%, a gain of 64 cents to $15.88. Birchcliff Energy a mover as well. It gained 4%, 30 cents to end the day at $7.56. It's up 60% over the last year. Let's get more on the movers from Bloomberg's equities reporter Stephanie Hughes, who joins us now. Stephanie, the TSX on a run for the past few days. Where's the momentum coming from?
Absolutely, Morella. Like you mentioned, it was momentum is the right word for it. The TSX hit another all-time high, like you mentioned, crossing that 32,000 point threshold for the first time ever earlier this week. And it's really part of a year that's been characterized by back-to-back record closes. So this time, it's the momentum is really coming from a massive metals rally that had a new burst of exuberance this week after gold crossed its October record of $4,381 an ounce. It's also on track for its best annual performance since 1979. So it's been a few decades since we've seen gold have a run like that. Similarly, we've seen silver spot prices break a fresh record above $70 an ounce just today. And really, these prices are being lifted by traders making these bigger bets that the U.S. Federal Reserve will cut rates at least twice next year. That's after they've cut a few times over the course of this year, which gives precious metals a tailwind since it's an asset that doesn't pay interest. So it's also gaining because of rising geopolitical tensions coming from the U.S. intensifying oil blockade against Venezuela and tensions spiking between Ukraine and Russia. So because gold and silver are considered safe haven assets, during times of uncertainty, uncertain headlines like this will cause investors to flock to those areas. So this in turn has boosted the TSX a lot this year because our main stock index is heavily weighted towards the companies that pull these metals out of the ground. So gold miners, silver miners, they take up a big portion of the TSX. So that in turn is lifting the whole index up with it, creating back-to-back record breaks and outperforming the U.S. markets, Morella.
All right. Uncertainty is good for gold. So which stock has moved the most this year in metals?
Undoubtedly, it is Discovery Silver, which is said to be the best performer on the TSX this year by a long shot. It is surging by over 1,100% so far this year. That's a sharp rebound for the precious metals miner that 2024 year that they had, where shares kind of drifted lower into the red a bit, but it's really riding that metals wave coming from a place of being undervalued now. Sharply rising above most other companies. But there's also other miners on the move. In fact, most of the top 10 performers on the TSX this year were miners, including Aris Mining, G Mining, Venture, Lundin Gold, and a few others on that list. So gold has been the story for the TSX overall this year, which has been, like I said, outperforming the S&P 500, which only really has one publicly traded gold company, so they couldn't ride the same wave to the same, to the same degree. And this is, has at the beginning of this year, a lot of traders were coming into this with this sense of anxiety around tariffs potentially weighing on Canadian businesses. But our publicly traded firms have actually held up pretty well in this environment, better than expected. And the gold rally really gave the TSX quite a burst of strength. Bank earnings are also another pillar of support since their earnings this year were pretty robust. So the strength's coming from a few different directions, but gold definitely put a shine on Canadian stocks this year, Morella.
All right, we will leave it there. Stephanie Hughes, thanks for the update.
Thank you.
Now, U.S. stocks rose for a fourth straight session. Artificial intelligence names continue to move. Matt Orton is the chief market strategist at Raymond James Investment Management. He'll join us in just a moment. U.S. markets rose today, even as expectations for another interest rate cut by the Federal Reserve in January declined after a very good GDP report in the U.S. My next guest remained optimistic about the market heading into the new year, especially on small caps. Let's go to Matt Orton. He's the chief market strategist at Raymond James Investment Management. Matt, thanks for joining us.
Hi, Morella. Great to be here.
Can I start with gold, which also had another record high today? Are you taking, or what are you taking from the new records we're seeing in gold?
So, Morella, I've been optimistic on gold throughout 2025, and I remain optimistic in 26 because I think It reacts to a number of different catalysts in this market. I think it reacts to US dollar weakness. It reacts positively to uncertainty that we have, and there's still going to be uncertainty heading into 2026, especially with respect to elections that are happening at the end of the year. But really, I think the biggest mover of gold this year has been related to this idea of de-dollarization and also just diversification of central bank reserves. And that has really helped provide an institutional push and bid for gold. And on top of that, it's been under-owned in retail portfolios. And so finally, this last wave, the parabolic move up you saw in October, I think was more related to that retail trade coming in. But we've reset from that. And I think the base and the new highs we're making are definitely sustainable in the future.
Okay, so what else are you seeing do well at the end of the year?
So it's encouraging to see that the AI trades find a little bit of footing. Earnings from Micron, I think, certainly helped to remind investors that all is not lost with respect to artificial intelligence. So I think that trade is working fairly well into the new year. But what else is really important is that we're seeing cyclicality work. And within cyclicality, financials are really starting to be an area of strength across the broader market. So I like big banks. I especially like regional banks that have more leverage to a steepening yield curve. And I think over concerns with respect to credit and credit conditions. I think we've overstated how much risk there is with respect to private credit and challenges to regional balance sheets. And so I really like the setup from a valuation perspective and fundamental earnings growth perspective going forward.
Let's get back to big tech for a moment. As you said, it did gain some ground back the last couple of days, but it's been on a slow burn, I guess, since November. Are investors overly concerned about spending, or in some cases, should they be concerned?
You know, I think what we got a reminder of in October and into November, Morella, is the fact that the rising AI tide is not going to lift all boats going forward. There's been such a strong bid and upcycle to anything and everything that's been AI related. And going forward, the market is really trying to look at what companies fundamentally are leaned into the durability of AI growth going forward. Who is going to be able to continue to grow their earnings at 20, 30, 40+% year over year going forward. And I think everything got taken down, and the companies are seeing finally start to rally are the ones that the market believes are going to be the biggest beneficiaries of AI going forward. So I think selectivity is the name of the game with respect to the AI trade in 2026.
So, Matt, are you looking these days outside of North America? And if you are, where are you looking?
I am. I think, and what I've been telling a lot of our clients is that while you still want to be levered towards growth and having kind of a core growth bias in your overall portfolio, there are ways you can get ballast and help diversify your overall portfolio from both a risk and correlation perspective, gold being one primary way to do so. But in addition to that, international markets look attractive. And going into next year, I really like the setup for emerging markets. Emerging markets should benefit from a continued weaker dollar. And you're also seeing fundamentals in countries like India, where you've had not such a great year for the market, but we finally had an inflection with respect to an earnings cycle, low correlation to U.S. markets, and incredibly strong GDP growth set up for what I believe are going to be strong tailwinds into next year. And even markets like Japan or financials in Europe have very, very strong tailwinds around them that aren't that correlated to the overall AI trade that's been driving U.S. markets over the past few years.
Okay, so emerging markets there. You also like small caps. Are there certain sectors in small caps you're looking at?
So within small caps, healthcare is one area that I like the most. Biotechnology has been an area I've been adding weight to and encouraging clients to add weight in their portfolios. We have a very good M&A environment that I think is going to pick up next year. You also have a number of larger pharmaceutical companies in the U.S. getting towards the end of their patent cliffs. That should definitely benefit the biotechnology and life sciences space down market cap. And again, financials, regional banks are a key area as you go down market cap that I think can do well. And then also investors should look at areas like industrials tied to that cyclical trade, the fact that you have resilience and strength in the US market. I think that can work well both on the AI side, more of the data center play, as well as the machinery and equipment part that's investing in more tangible, I'd say, road projects, rail projects, actual physical infrastructure in the US. I think all of that sets up nicely, particularly down market cap in the smaller company space.
All right, Matt, I'm going to leave it there. I'm out of time. Matt Orton's Chief Market Strategist, Raymond James Investment Management. Thanks for your time. I appreciate it.
Thank you.
Coming up next, shares of Novo Nordisk got a big bump today after the FDA approved the first ever GLP-1 pill from the Wegovy maker. We're back in a moment. The U.S. has approved the first ever GLP-1 pill for obesity, and that moved shares of Novo Nordisk up today. Let's go to Evan Seekerman on this. He's Managing Director, Head of Healthcare Research at BMO Capital Markets. Thanks for joining us today.
Thank you for having me.
How different is the Wegovy pill from the injections that are being used these days?
Great question. So from an efficacy perspective, which everyone cares about, the weight loss is on par with what you get from Wegovy, which is Novo Nordisk's flagship injection. Except the difference here is you have to take it every day. So that may be a benefit for some folks who don't like needles, but a drawback for people who don't want to deal with it every day. But what it does, it allows a wider swath of patients access to this drug because some may want the pill, some may want the injection.
Okay, are they about the same price or are the pills cheaper?
We don't have official word on pricing, but if you remember back in November, there was some talk around the cost of the oral GLP-1s starting at $150 a month and going up from there for higher doses. So net probably a little less than the injectables, but we know the price of the injectables has been going down. We saw several deals made with Novo Nordisk and Lilly back in November, same announcement, also potentially expanding access in U.S. Medicare for $254 a month.
Okay, Evan, you have said Novo needs the win. Why is that?
They needed the win because last year or 2025 for Novo has been tough. It always felt like they were, kind of not really focused on execution and that Lilly was just taking a lot of share and momentum in the market. We saw a new CEO came on board, restructuring. They lost the Metsera bidding war with Pfizer. So they really needed this win to start off 2026 right. They're not out of the woods yet. Plenty more to do, but this definitely helps.
Okay. Competitors, of course, are getting their pill, trying to get their pill to market as well. How quickly do you expect the competition to be out there?
Great question. So the key competitor is Lilly's orforglipron. Should be approved in the first half of next year. There have been questions around the use of a priority review voucher to potentially accelerate that. We don't have clarity on that. So I would assume, somewhere between first and second quarter in 2026 does give Novo a bit of a head start, but they don't have years and years and years to kind of, crush the competition. And we know Lilly is going to be very aggressive in marketing and launching their product.
Yeah. Does first out of the gate guarantee bigger market share historically?
Sometimes it does. Other times it's hard to say. Sometimes it does because there's momentum. But if you have a competitor a few months later, it's going to be, kind of even footing and they're going to counter detail each other. There are differences in the product that I think each company will highlight.
And I imagine that consumers, patients, don't want to switch medications very quickly because sometimes some medications take time to build up and really work, and B, you don't know what side effects could change.
For sure. And I think if a patient is doing well on Wegovy or Zepbound, they're going to stay on this because they're used to the shots. It's a tiny needle, and I think it's really important to emphasize that. But for patients who are curious, who have wanted to get on this, GLP-1 to, lose weight, this could be a great option. Also, in some patients who are tired of using weekly injectables, could use this as maintenance therapy.
You mentioned, of course, there were discussion on keeping drug prices low in the U.S., deals that were struck.
Sure.
So could we see prices come down even further for drugs like these?
I mean, we model and expect that prices will continue to come down. And, the $1,100 a month list price is not the price that Novo Nordisk or Eli Lilly receives, nor what people pay. it's more akin to the cash pay price right now. Zepbound starter doses are $299. So expect them to come down, into the $200 per month range and even further later in the decade.
Okay. Let's talk a little bit about the fact that you have a hold on Novo. I'm wondering if this news has made you reconsider at all?
It's not enough. We downgraded Novo shares to a market performer hold rating back in April on concerns just that Lilly was executing, on all aspects and really moving forward where Novo was kind of faltering. And that was the right call this year. I think what I need to see from Novo to get that upgrade, a successful Wegovy pill launch. So really want to see enough supply come January where patients can actually get the product. I want to see also them kind of restarting growth in their GLP-1 market. I'm concerned that, some volumes in the injectables are maybe slowing next year and pricing is going to further erode that. Third, I really want to see the new CEO come on board and come up with a new strategy. Be aggressive, but don't break things. I didn't love the bidding war for Metsera. I thought that was a bit reckless. I'd like to see smart BD that helps propel the long-term trajectory of the company.
What do you expect the pill launch to look like, or what do you think it needs to be, as you mentioned, to gain the market share and hold on to it?
Sure. Well, remember, Novo has that exclusive deal with CVS, which is helpful. Also, they are a brand name, and they're very smart. They called it the Wegovy pill. It's not a new brand that folks have to learn. In terms of where we are versus consensus for next year, we're at about $1.6 billion, which is well ahead of the consensus that the company had provided ahead of this at about $700 million. We're bullish here. But I really need to see that execution and not just with the pill for me to really be bullish and more positive on the name.
So how easy is it to get these kinds of medications? I ask because initially it was associated with diabetes. Now it's been marketed more as sort of a weight loss pill. So is it something that that consumers will be easily able to get? Do they still need a prescription for it?
Of course you need a prescription. I frame these as serious medications for patients with serious disease that manifests as obesity, right? They're serious drugs. So you need to be under medical care. Access has gotten easier. I think what we're going to see next year is more cash pay. So Lilly Direct using platforms like Ro Health here in the United States. It basically kind of bypasses a lot of the friction you see with traditional obesity medicines providers. It's actually very hard to get into an obesity medicine clinic to get on a drug, but you can go on one of these telehealth platforms. I also expect that, health insurers and really kind of plan sponsors, so employers are figuring out how to cover these without breaking their budgets. And that's been a bit of a rub and a challenge. So a lot of these employers are actually pushing patients towards cash pay. And I think that's a bit of a different kind of conversation around insurance, but these are more accessible, although who pays for it, I think, is going to evolve.
All right. Evan Seigerman, thanks for joining us. Appreciate your time today.
Thank you so much.
Up next, what the 2026 trade outlook looks like and how will tariff wars impact the markets in the new year. Back in a moment. Here are the stories we are following today in the newsroom. GDI Integrated announced it will be taken private. The Quebec-based facility services company has entered an agreement with Birch Hill Equity and Gestion Claude Bigras. The $36.60 per share in cash, $36.60 per share in cash offer represents a 25% premium to GDI's closing price December 22nd. GDI's current management team is expected to continue with the deal, and it's expected to close in the first quarter of 2026, pending shareholder approval. Software company ServiceNow will buy cybersecurity startup Armis in a deal valued at $7.75 billion. ServiceNow expects to fund the transaction through a combination of cash on hand and debt. The deal is expected to close in the second half of 2026. Founded by veterans of Israeli military cyber intelligence, Armis specializes in identifying and tracking security threats. Alphabet has agreed to buy clean energy developer Intersect Power for $4.75 billion in cash plus existing debt. It is one of the largest deals by the tech giant to expand its data center footprint in AI. The acquisition intended to give Alphabet's Google access to more electricity for its data centers. The AI race has spurred mergers and acquisitions in the data center and power industries. The Canadian Pension Plan Investment Board and Goodman Group have agreed to set up a multi-billion-dollar European data center business. The Australian Industrial Property Investment Manager and the Canadian Pension Fund Manager will initially invest close to $4 billion Australian dollars to develop data center projects in Frankfurt, Amsterdam, and Paris. Construction should start by the end of June of next year. We've seen and covered much of the impact of U.S. tariffs. For more on what to possibly expect in 2026, we were joined by Jacques Shore, Government Affairs and Trade Specialist, Gowling, WLG.
I think that basically students of the economics, political science, government affairs, trade will be studying this year for a long time. It's been a remarkable year, but I'm going to give it a go. First of all, when I look at it, the year essentially started off effectively with a seismic shift as a result of the election in the United States with Donald Trump coming in. And to a great extent, that affected the world order and really dominated, I think, our Canadian political landscape as well. I mean, remarkable, as we saw, amazing rise of Mark Carney as our Prime Minister in the face of that, because I think Canadians recognize there could be a looming crisis ahead. Mm-hmm. So there's been a lot of work on since then, and really changing, I think, the dynamics of how we look at the world and how we basically look at ourselves. I'm actually quite pleased in the way we've addressed it. Let's remember that we started off essentially with a throne speech once the new Liberal government came in. And it basically said the true north is indeed strong and free. So we started off with something recognizing we had to look to ourselves, we had to strengthen ourselves. And then we came up with a One Economy Act that would actually create major projects that we would need to deal with. And obviously, we got caught up in a very significant, how can I say, set of changes with respect to our trading partner, imposing on us very significant trade tariffs, steel, aluminum, lumber. You just look at some of those key areas, autos, what that's done. It's upended us to a great extent. But at the same time, remarkably, we are looking to addressing those things. We're not looking to diminishing, I think, the trade relationship we have with the United States. I hope it grows. I expect it should grow. We've got CUSMA negotiations coming up. But we've been diversifying our trade in the way in which we have been reaching out to other corners of the world, to Europe, to the Indo-Pacific. These are countries that I think we can look to because we can rely on them if that's what we're going to do to grow it. We have a target in the next 10 years to increasing our trade to $600 billion, but that's in 10 years. So there's a fair bit of work that has to be done until then. So that is to a great extent on that trade side. And essentially, I can also say, as we look to the United States right now, there are other elements that we can look to, even just recently, the U.S. national security strategy that came out, which gives us some pause. I mean, I think, and I've shared with others, let's remember that we're very active in NORAD. Let's remember that we are partners in many ways. But this is also another, how can I say, glimpse at the way in which the Americans are looking at the world, and gives a sense how we have to look at them. I still say they are our allies, they are our friends, and we just have to look to the last 40 years, which has been incredible in terms of our trade relationship. But we're careful, and I think that we have to understand that there are risks out there. There is uncertainty, there is unpredictability to some extent, but we're going about it, I think, in a very sensible way at this moment.
Now, it's been, I guess, 8 months since all of this really started to unfold. Reaching out for trade, are we starting to see results for developing trade outside of North America, outside of the U.S. as our partner?
So my sense is yes, while we haven't necessarily concluded, how can I say, arrangements completely as we would want them to, we know that there is a focus on that. But I'm going to also shift to the fact that we understand that our relationship with Europe is extremely important. Just recently, we concluded an agreement with them that touches on basically security matters. And I think that's important. On the trade side, the meetings, just think about the number of visits actually our prime minister has taken in different parts of the world to actually deal with trade. Someone just the other day, mentioned that our prime minister is more of a merchant. I mean, is certainly a banker, but very much a merchant in terms of wanting to open up those doors. And so I think that is happening. There's much, much more activity, certainly as we're looking at Germany, as we're looking at Italy, as we're looking at countries that in the past, Switzerland, that have really now taken a step. I was just in Switzerland a short while ago, meeting with potential investors there. And our trade commissioners are actively engaged. We've just made a significant commitment in our recent budget for enhanced funding for those efforts abroad. So this is moving, I think, in the right direction. I basically would say, is it moving fast enough? And I think that there is an element there that we have to really seriously look at how we've addressed things in the past. We have issues that we've got to address. We've got regulatory burden, we've got red tape, unnecessary red tape in a number of instances that don't make us all that, how can I say, palatable, perhaps, as a country to invest in because of some of those difficulties. But I believe we are basically looking at them. Can we deal with them quickly enough? I think that that's a challenge. We still have our internal trade barriers. I know that that was something that the Prime Minister and the Premiers basically made a commitment to actually address fully. They are, but again, it's one of those things that I think we have to press our politicians to make it happen. If we really talk about a one Canada economy, then it really means that the provinces, along with our federal government, have to align, and they have to recognize that the challenges we see today are not like we've seen in decades. So they have to come together on that.
Jack Shore, Government Affairs and Trade Specialist, Gowling WLG. Up next, we'll look at how robotics and AI are reshaping the way we produce food. Back in a moment. Robotics and AI are reshaping how food is grown. Bloomberg dived into this new age of farming with an innovative robotics farm equipment company and visited a research lab to see how AI is factoring into the future.
Yo, so did you change the pump?
The pump's new, burned out. Completely burned out. It was hot.
Daniel Alameda is a third-generation farmer in the Salinas Valley, where he grows thousands of acres worth of broccoli, cabbage, and lettuce, among other things. Like with any farmer, the scourge of his operation is weeds. And about a year ago, Alameda turned to a cutting-edge solution, an AI-powered weeder. The device, which attaches to the back of his existing tractors, uses high-resolution cameras and sensors to automatically detect unwelcome plants and spray them with a precise dot of herbicide.
So what the driver sees in the cab is real-time footage of what's happening. The crop that's there and the weeds that we are trying to remove. The driver sees the machine analyzing the data and then taking the shot. You're seeing decisions made in real time. We definitely had no AI not that long ago. The owner, operator, manager was the AI. We were making the decisions. But we realized quickly about 10 years ago that we could use software to make better decisions. We are trusting AI to make us better, more efficient, and faster.
We're starting to kind of notice AI getting a lot more penetration on farms across the country. Farmers are using things such as drones, autonomous plows, crop sprayers that can tell the difference using AI between a weed and a crop. And a lot of them are using data collection to just suck up all of the information from the farm. John Deere is the biggest farm machinery maker, and they have a goal by 2030 to be able to farm 100% autonomously. So I think this stuff is here to stay.
And there's really not a lot of other ways to just kind of get it all done.
At UC Davis, researchers are using AI in another way, to better understand individual crop genes, so they can make them healthier or more resilient to changes in the environment.
What you're seeing here, the first prototype in half a day was this thing, a bird box right now. It's one thing to collect the data. That part's actually kind of easy. You go out in the field, you collect the data, but then you generate this massive data set. It's like, imagine if you took your camera, instead of just taking red, green, and blue, which is what it does now, took another 400 bands of light. So it's this cube of pictures. And so what you end up with is this massive data set that has to be processed somehow.
That's where artificial intelligence comes in. Scientists at Davis are training computer models to detect everything from the size and shape of a flower to the direction that a leaf is pointing.
Plant breeding is really interesting application for AI. Let's say we're working on bee. In this example here, what we have is over 330 different genotypes of beans that have been planted out in a field. And so what you're looking for is like maybe some of these have really big beans or certain patterns, or the protein content is high or the fat content is high. It's just really hard to measure and see and score by humans on the ground. And then if we can process all that data using machine learning and AI, it allows us to extract those complex traits. I think farmers from 50 years ago, if they saw what AI could potentially provide them today, I think they'd be very excited. Using computer vision, we can rapidly accelerate that process of searching through all these possible children, right? The traits that we care about. And so it can take us from taking 30 years to breed the crops that we want to maybe taking 3 years. The fact that we can then take something that seems so state-of-the-art and advanced, like AI and machine learning, and bring those two together, I think there's something really magical about that idea.
What's the right time of year for me to begin setting up my raised bed nursery?
The best time to start setting up your raised bed nursery for transplanting paddy saplings.
The AI tools being created in collaboration with the team at Davis aren't just about using AI to process and analyze data. Rick and Gandhi has been building a large language model app for farmers in developing nations.
So the small scale farm we work with are primarily in South Asia and in Sub-Saharan Africa, specifically in India, Kenya, Ethiopia, Nigeria. You could say that what we're building is a type of ChatGPT for farmers, but they're not looking for generic Wikipedia or ChatGPT answers. They're looking for information that is proximate to them and location specific. There's a bunch of challenges that we face. There's a need to support all the various languages and dialects that farmers speak. They don't use scientific terminologies like kilograms or percentages or chemical names. We need to be able to train these systems for speech-to-text recognition, for their local colloquialisms and vernacular, and also not just speech-to-text, but also text-to-speech, so that farmers who often have low literacy can be able to interact with these systems.
Of course, AI is not without its own environmental costs, something those working in farming are all too aware of. Training a large language model can use up millions of gallons of water, and data centers dedicated to artificial intelligence can do real damage to the land and power grids around them.
These farming communities have been so often left out of our collective improvements of digital technologies. And so I think that we also have to ensure that there is inclusivity to be able to access this technology, even if there might be an expense of energy and cost for them to do so. It's about providing them more of a level playing field.
How AI impacts the environment and is that relevant to agriculture is a really important one we should be asking. On the research side, we're using, honestly, very small amounts of resources, like a few GPUs, 8 to train these, whereas some of these large language models are using more like tens to hundreds of thousands for many months as opposed to 8 hours. So I don't worry too much about our personal impacts. I know what they are. But I think like when you think of scale, like of the industry, I definitely worry about the energy effects of AI. We are at the beginning. It's moving quickly. And I think we come back and revisit this 3 to 5 years from now, we're going to be pretty blown away with the impacts that it's had already.
Okay, so what we're going to show here is, so this is the live feed from the robot, right? We have Dai here to see the shots well.
The weed-killing robot that Daniel Alameda used on his farm is produced by a company called Verdant Robotics. Gabe Sibley, who spent his early years working on the Mars rover, founded the company in 2018.
The machine knows where it is in space, so it's got spatial AI that allows it to solve the where problem. Where am I? It also solves the what problem. What am I looking at? Is it a carrot? Is it a weed? What type of weed?
Initially, people thought that autonomous navigation would be a really valuable thing to bring to the market. The thing that you have to understand is that it's not the navigation of the tractor that's the job they're worried about. It's the 100 people walking behind the tractor that are opting to go work at Starbucks or Walmart or in a data center labeling images. That shift in labor is the one that's causing them heartache. Efficiencies we need in ag are substantial. In the next 50 years, there are folks that say we need to grow as much food as we've grown in the last 10,000 years. Half of the habitable land on Earth is already under cultivation. We have to do it more sustainably and more efficiently.
What you'll hear over and over is just the tight labor market. There's never enough sort of field workers or machinery operators. A lot of farmers would not recommend their children staying on the farm and would kind of push their kids to find careers elsewhere. But these machines are also an opportunity to attract, the younger generation that's interested in video games or that's interested in new technology. And that might be a way to sort of start clawing back some of the folks from the city back to the farm.
We have just stuck our big toe in the water for the first time, and it seems like it might be inviting. It's also a little scary. We don't know exactly what's going to happen. As a species, as we start to automate all types of work, really not just agriculture, you've now entrusted all that work to a machine. And so we better make sure that we are still in control. The difficulty then is like if the switch goes off, do we remember how to farm? We better.
Coming up, hot picks in banks, including one that's currently sitting on about US $16 billion of excess capital. More in a moment. Time now for Hot Picks. We were joined by Mike Clare, Senior VP, Senior Portfolio Manager at Brompton Funds, to discuss his top picks in banks. And we kick things off with Citigroup as his top pick, a stock he says that will likely benefit from several trends in the banking sector, including expense efficiencies driven by AI.
Citi's been our number one pick in the banking sector for the better part of the last year, and we still think that they have pretty strong momentum into next year as well. Capitalizing on the three key trends we see in the space. Number one being regulatory relief. We're also bullish on the capital market cycle, which is about 30% of their business. And of course, expense management. On the regulatory side, Citi sits on about $16 billion of excess capital currently. But we should see in the first half of next year, we should see some pretty tangible things coming out of the U.S. administration on the regulatory side for banks. Number one being reform of the GSIB surcharge, which affects the capital levels for the largest banks in the U.S., as well as we should see finalization of the Basel III endgame rule that we expect to come out next year as well. For Citi, that means they could double their excess capital levels, and we expect them to buy back a lot of stock. They bought back about 2.5% of their stock in the third quarter of alone. We could see them buy upwards of 10% of their stock through the end of next year, and notably because they traded at a discount to other banks out there, trading around book value now. They can do that on an accretive basis for their shareholders.
It looks like there's been quite a spike in Citi lately, Mike. It looks like investors are buying into the thesis here.
Yeah, I think that the market's starting to catch on. They had, they're looking at, they've been an underperformer on the return side. They've had a target of 10 to 11% return on tangible common equity for 2026. It looks like they're going to hit that. They announced it in Investor Day for May 2026, where they should come out with new targets. So we think they should, be able to do better than expected, raise guidance, even with consensus numbers out there having them growing earnings per share by over 30% in 2026 alone. So we think there's potentially upside there.
So the return on Citi over 5 years, about 135%, not bad, beating the financial index. But Morgan Stanley's been a charm to own. People have trebled their money in the past 5 years, including dividends, but you see more upside.
Yeah, we still see upside across the capital market space. Really, I mean, Morgan Stanley in particular has built a very strong equities business, and they've done very well on the trading side. But we're just actually starting to see an uptick in investment banking revenues, which is really their bread and butter. Investment banking, capital markets overall, up until the last couple of quarters, has really gone through quite a bit of a downturn with M&A activity running something like 30 to 40% below long-term averages, ECM activity running more like 50% below long-term averages. That's just started to tick higher. Of course, there's lots of talk out there about potentially some big IPOs for next year, the likes of OpenAI, Perplexity, potentially some others, right? So Morgan Stanley has a very strong technology franchise in particular, very strong equities business, and we expect them to be in the game on a number of those deals. Just to give you a sense of some of the numbers, in their most recent quarter, Q3, investment banking revenues were up something like 44% year over year. ECM alone up 80% year over year. And we think that momentum really continues into 2026, and there's potentially more upside to consensus as they continue to perform well.
And then finally, Citizens Financial has caught your eye. What's the attraction here with what do they do?
Yeah, so Citizens Financial is one of the regional banks. We do like not just the large cap banks. We like regional banks or some of the higher quality regional banks heading into 2026. So this is your typical retail and commercial bank operating in New England, the Mid-Atlantic, and Midwest regions. But what we really like about it is there's pretty strong visibility in terms of returns improvement into the next couple of years. So they're currently operating around 11% return on tangible equity. We think there's pretty strong visibility to improving that number to 15% over the next 18 to 24 months, just given some lower yielding assets roll off and they can reinvest in higher yielding assets given that rates have moved higher over the past couple of years. They've also done a really good job. They've been focusing on building out a private bank, which targets high net worth investors. And that's starting to have a big impact on results as well, impacting earnings by about 7% this year. That could grow to 10% next year and potentially doubles longer term. And then on the capital side, Citizens, relative to its regional peers, has one of the highest capital requirements. These smaller banks only participate in the stress test every 2 years, so they didn't participate in 2025. So when they do participate next year in 26, we expect to see a decline in that number similar to some of their peers. And ultimately, they'll have excess capital, which they can either deploy into the business to grow the private bank or to put into buybacks. And again, this is a company that's growing earnings, something like 30% plus in 2026 and potentially another 20% plus in 2027, trades at 12 times earnings, which is just too cheap given the fundamentals. So it's a stock we really like here.
Mike Clare, Senior VP, Senior Portfolio Manager at Brompton Funds. Christmas trees represent big business, generating more than $50 million each year in Nova Scotia. But as U.S. imports dip, local tree sellers are struggling. CTV's Paul Hollingworth reports.
Christmas trees represent big business, generating more than $50 million each year in Nova Scotia.
Last year we sold about 75, and this year we did about 350.
Most tree lots around the province are sold out, a signal this season has been productive for sellers.
Somewhere it's up to 10%, some more. So it's really encouraging to see.
While local business has climbed, U.S. exports have dipped compared to 2024.
Unfortunately, our shipping market is down about 40%.
The trade tensions between Canada and the U.S. have resulted in a major blow to some businesses' bottom lines, with regular buyers backing off because of tariff fears.
There wasn't a tariff on Christmas trees. It was just the uncertainty and the nervousness within the market. We've taken some pretty big hits this year for sure.
Pushing away any bad news, Colin Hughes is focused on the upside. His local buyers are still choosing his real trees in large numbers instead of artificial options.
Well, there's only one way to get the smell of Christmas or the scent of Christmas, and that's with a real tree.
Selling those trees in large numbers is a top priority. After losing business in the U.S., Colin Hughes has a backup plan. He hopes to expand his business and sell trees in parts of Europe and Asia. Paul Hollingsworth, CTV News, Halifax.
That does it for The Close. Thanks for joining us today. We'll see you back here again tomorrow.